pause and not a break in the price trend. That's according to our next guest, who says rapid urbanization in the emerging markets will continue to push up prices. Philip Blumberg is founder and chairman of Blumberg Capital Partners. Philip, really good to see you. Is it interesting that you should talk about rapid urbanization, because that brings into context another part of your repertoire of products and areas you look at, and that's commercial real estate. And in many ways, you were saying to me off camera, this is just another commodity.
Well, if you think about it, we own office buildings around the United States. Office building is a basket of steel and glass and aluminum and copper. So commodity pricing has a huge impact on our bottom line replacement cost for office buildings. We track those costs. But prior to 2008, they were increasing at a rate of 12 to 15%. That was driving up the replacement and therefore the sale value of office buildings and real estate in general. So they are commodity tied, and every investment in real estate is an investment in commodities.
And is real estate, I'm presuming, just another mirror of what's going on globally, i.e. still a lot of demand for new real estate in the emerging markets, and actually we've got very high inventories in the Western world?
Yes, that's generally the trend. In fact, in China, the 5-year plan calls for about 180 million new people to move into the urban zones. Not only is that new construction in their urban zones, but the urban zones are underpopulated in terms of size, undersized in terms of the units. So yes, you're finding emerging markets, India, China, which represent, and South Asia represent half the population, urbanizing. And you find the Western markets still oversupplied in general in housing.
Philip, Steen Jacobsen was an analyst who's been spending a bit of time in Asia recently. Jeff was talking to him earlier on with Philip and beg pardon, with Guy, and just making the point, actually, he's worried about the growth story and the continuation of that story. You're less so.
I'm less so over the long term. I'm not less so over the short term. There's certainly some erratic volatility. Growth in those zones at 8 and 9% is not sustainable. When you start to pick up labor pricing at levels that it is trending towards, we're going to see a moderation in growth. So it's not the growth levels that fuel, to me, emerging market expansion. It's the sheer volume. When you talk about 3.5 billion people, it doesn't require 9% growth. At 2, 3, 4% growth, it's a huge impact on this world.
You can still have crashes with hundreds
Absolutely.
of millions of people. And what worries me is that analysts I talk to say China is making exactly the same mistakes that Japan made. It's now building a lot of low-cost housing, and it is not making what is called a hedonic adjustment. It is not adjusting for the fact that these houses are much lower quality. It's therefore massively understating what is a price and real estate boom. And I think once interest rates are tightened and China gets serious about inflation, which it is now, we really have no model for how it will react. And I don't think it's going to be that pretty a picture on the urban housing front.
I will agree with you, Guy, that I think they're staving off what could be a very, very large and long cycle. The impact on commodities, though, continues to fuel that. Just the consumption, low quality or high quality, is a huge consumer of commodities.
But just by contrast, I see come out today that actually US home supply at 174,000 is the lowest ever recorded as construction activity slowed. Don't you actually take a rather expensive house in Shanghai and switch to the States now?
Well, I think one of the problems in the States is that our growth in the States is not on a sharp incline. We're finding that people can't sell their houses, their current homes, to move into anything else. So we're in a static market in the States. If there's not much liquidity in the housing market. In the commercial market, in the office building market, it's an entirely different story. Last year we had a 16% return, and you're seeing a lot of volume in trading, and you're seeing pricing go up. The problem in the housing market in the States, and I think in general in the West, is lack of liquidity to create any real volume in supply.
Your affordability numbers look amazing. Isn't it time to just dip your toe into the retail housing side?
If you have cash to invest and you're not relying on debt as a homeowner, absolutely, this is a superb time to be investing in U.S. housing.
I've got a broader question about the appetite for non-U.S. assets of U.S. investors at the moment, because over the last 2 or 3 years we've seen it wax and wane, and I thought we were seeing in the pickup in some of the consumer metrics and also the housing numbers that Americans are starting to get behind their own economy again a little bit here. But when I listen to you, it sounds like you're just looking for opportunities outside the States.
We are looking for opportunities outside the States. Here's what I think happens. Every 3 months, we start to get some consumer confidence. We start to get some business confidence. And I'm not suggesting the industrial companies aren't investing in the States. But when you talk about U.S. investors, that retreat to the shell of liquidity, that retreat to the shell of the market rather than a long-term investment, whether through a fund or long-term commitment. The shock to the system, it could be the Middle East, it could be Japan, but in a market that's seeking certainty, we keep supplying uncertainty.
Guy, you were looking interested on that point.
Well, I just think we've got a big reorientation of investment globally, and I think we're moving from equities, commodities, real assets in the East, in the emerging markets, to real assets in the West, and we're looking at currencies and interest rates as the opportunity in the East. So I think there's a huge switchover, and I think you'll continue, as I've said repeatedly on this program, to make far more money on the Dow Jones than you'll make in Shanghai and in India, and you'll make far more money in the currencies and the interest rates of the emerging world than you will in the West.
Well, here's the thing, that as we've sat here and watched the Chinese economy grow at these phenomenal rates, you really struggle to make any money in listed Chinese equity markets. And that's the conundrum, it strikes me. We all want to see a shift in asset allocation into the emerging world, but just finding something that you can buy that isn't gamed by the owners of the business or by the command structure economy, the government. It's tough.
It is, and something that is in any kind of transparency in those emerging markets is. We are concluding a deal in partnership with the U.S. government and one of the large South Asian governments to deal with grain storage and food safety and security. That's one of those emerging markets where there is a desperate need and where the gaming can't be quite so severe because you're not investing into a speculative market. But that's an exception. I would agree. There's never been a time where the West has looked so good for what the East used to look so good for. And if that's the point, I do agree. We're looking elsewhere, but we're also looking at commercial real estate exposure. We're absolutely looking only in the U.S. and only in the West because that's where the deals are.
We've got to leave it there. Philip.